Moral hazard is a situation where one party takes more risk because another party bears the cost of that risk. Moral hazard can lead to market failure when it distorts the allocation of resources and creates inefficiency. In this session, I will explain how moral hazard contributes to market failure using some examples from the financial sector. One example of moral hazard is the problem of too big to fail institutions. These are large financial institutions that are considered to be so important to the overall financial system that they will be bailed out by the government if they get into trouble. This creates an incentive for these institutions to take excessive risks, such as investing in risky assets or lending to subprime borrowers, because they expect to enjoy the profits if things go well, but shift the losses to the taxpayers if things go badly. This can lead to market failure because it creates a misalignment of incentives between the private and social costs and benefits of risk-taking. It also reduces the market discipline that would normally prevent excessive risk-taking by imposing higher interest rates or lower credit ratings on risky institutions. Another example of moral hazard is the problem of asymmetric information in financial markets. Asymmetric information occurs when one party has more or better information than another party. For example, a firm selling subprime loans may know that the people taking out the loan are liable to default, but the bank purchasing the mortgage bundle has less information and assumes that the mortgage will be good. This can lead to moral hazard because the seller of the loan has an incentive to misrepresent the true quality of the loan, knowing that the buyer will bear the cost of default. This can lead to market failure because it reduces the efficiency and transparency of financial markets. Moral hazard can be reduced by various policies, such as imposing regulations on financial institutions, requiring them to hold more capital or liquidity, or imposing penalties for excessive risk-taking. Alternatively, moral hazard can be reduced by making the parties share the risk more equally, such as by requiring co-insurance or deductibles in insurance contracts, or by making creditors share in the losses of debtors through debt restructuring or bankruptcy. However, these policies may also have some drawbacks, such as reducing innovation, competition, or access to credit.